Hi and welcome to this week's Business Finance Bulletin, episode 101. This week's Business Finance Bulletin with me, Rob Warlow from Business Loan Services. Now, before we get into business as usual, a thank you. Thank you very much for the feedback on episode 100, which, if you recall, really was full of outtakes and mistakes that I'd made while recording previous bulletins. A bit of a departure from the norm, but I'm glad you enjoyed it. If you haven't viewed that yet, just go along to our YouTube channel and there search for episode 100 and you'll find the bulletin there. So let's move on now to this week's Business Finance Bulletin. So this week we're going to be looking at getting finance against your credit card receipts, business confidence generally, and also look at the importance of keeping your financial information up to date because it can help you grow. And in my business finance tip of the week, a clip from a seminar in which I share the key question that banks ask when they're looking to lend money to you. With a new service being launched by WorldPay, one of the world's leading credit card services provider, and Liberis, which is a working capital facility provider for businesses. Now, we know that there are many businesses out there that take payments through credit cards, and that means there is a consistent, visible flow of turnover coming through your account. Well, WorldPay has realised this and understood that there is a working capital need for many growing businesses. So what WorldPay have done, have linked up with Liberis in order to provide a facility for businesses to get a loan against future credit card repayments. So how it works is you can get a loan up to a maximum of 1 month's credit turnover through your credit card account. From there then you agree a fixed percentage that you will pay back every month from your credit card receipts. Now this means it's not like a traditional loan in that you would agree, say, a fixed repayment of £350 a month. This is just based on a percentage of your credit card repayments, whether that's 10%, 20%, whatever it is you agree. Now the major benefit of this is if you're a seasonal business where a period of time when your business goes very slow, you still don't have to find that £350, for example, on a traditional loan. Because your repayment is based on a percentage of your credit card receipt, it means that your repayment is lower in that month. But in busier periods then, the percentage remains the same and so you pay a higher amount. So it's really a very flexible way of getting hold of additional working capital. So if you're a WorldPay customer and you want to know how you can access that, just go along to your WorldPay account or pop along to Liberis, that's liberis.co.uk, and you'll be able to find out more from those two and how you can access that great facility. Staying with the alternative finance scene, some great news from Ratesetter. Now, Ratesetter is a crowdfunding platform, and when it started out, was very much focused on providing loans to individuals. But recently they started lending to sole traders and partnerships. And in fact, as at the end of September 2015, they had lent out about £137 million to the small business market. And that constitutes about 30% of their overall portfolio. Now, that's really good news. But more importantly, they've really pushed the boat out over the last 3 months. And on a year-on-year basis, they've seen a 60% increase in loans they've given to small businesses. Well, the news there is now, clearly they've got comfortable with the market, and they've formed a further partnership with the British Business Bank, which is an umbrella organisation run by the government to help fund alternative lending providers. So they've linked up more funding to really now go much more aggressively into lending to small businesses. So if you're an SME and you're looking to grow and get additional working capital, just pop along to ratesetter.com and there you will find more information on how you can access their business loans. I've mentioned in previous bulletins about one of the problems that we continually face when raising commercial finance for businesses is the lack of up-to-date financial information. What should be a very quick application process can sometimes turn into a long, drawn-out affair while we wait for the accountants to bring all the figures bang up to date. Well, the importance of having up-to-date financial information has just been re-emphasised in a survey that's been launched by the accountancy firm KPMG. Now, they found that many small businesses typically are relying on information which is 4 months or more old. That's just too late. And in fact, they found out that 51% of business owners say they make investment decisions on buying material, stock and hiring staff based purely on looking at the bank account and what invoices they have outstanding, not really looking at the bigger picture. But more importantly, what they found though is that businesses with more up-to-date, accurate information typically grow by 8% compared to a growth rate of just 4% for businesses who have financial information which is 9 months or more out of date. So the ones with up-to-date financial information are growing twice as fast as those that don't. So if ever there was a compelling reason to make sure that you bring your financial information up to date, there it is. But not only that, it makes our job that much easier when we're looking to raise finance for you as well. So the key message there is get your information up to date, because guess what? You never know when the deal of a lifetime is going to land on your desk and you need to move fast. That's when up-to-date financial information really pays off. Business confidence. How confident are you about where your business stands today? And more importantly, how confident are you feeling about 2016? Well, this is a question posed by Close Brothers as part of its quarterly Business Barometer survey. And what Close Brothers found is that 25% of businesses say they're expecting to grow in 2016. Good news, but 56% of them are expecting to stay the same. So, a bit of a mixed bag there, and certainly does reflect what we're seeing, which is mixed confidence levels amongst many businesses. But I guess the real evidence of a confident business owner is appetite to borrow. And the survey found that 29% of businesses are looking to borrow in 2016. So, about nearly 30% of businesses looking to gear up in terms of investment into plant and equipment and additional working capital to fund growth. So clearly, some mixed messages, I say, coming out there. The key message for you is plan ahead. As we're coming to the end of 2015, as I record this, sit down and think about where you want to be in 2016. As in, what kind of goals do you want to achieve in terms of turnover, profit, new products being launched, a number of staff being hired, whatever it may be. But make sure that you start off 2016 in a positive, confident mood by being in charge of your destiny and planning ahead exactly where you want to be. And hopefully you're going to be one of those 25% who are going to grow their business in 2016. Moving on now to my business finance tip of the week, and a clip from a seminar in which I share one key question that a bank will ask of you when it's looking at your loan application. The second step then is something that banks may not tell you that they're looking at, but they are. So what they're looking for here are things that can perhaps upset your business in some way. These are things that are going to create obstacles in your way. Because what the bank is looking for here, it's asking a key question when it's looking at a business proposal. What they're looking for is the answer to this question. What can happen to this business that could lead to me not being paid? So what we're looking at here really are the risks within your business. Because the banks are in the business of managing risks. And do you know what? You should be as well. You should be in the business of managing your risks. There are a whole host of risks that each and every one of you are facing in your business. And this is what the bank is looking for. The banks are looking for the banana skins that are going to be tripping you up. The things, the obstacles that are going to prevent you from repaying your loan. So let's be clever. Let's be clever. Let's see if we can head the bank off at the pass and get there first, by identifying those risks and thinking about those risks before the bank does. Well, that's it for this week. As ever, I hope you enjoyed this bulletin. Don't forget, of course, that we have the podcast version of this available on our SoundCloud and iTunes page. And also, because we had a special 100th episode last week, which included outtakes, it really didn't translate to a podcast version. So I did a special podcast version covering information that is not available via the normal video bulletin. So to seek out that, again, go to our SoundCloud and iTunes page, just hunt out Business Finance Bulletin, and then have a look at Business Finance Bulletin episode 100. That's it for this week. I hope you enjoyed it. As ever, if you did, please share it amongst your colleagues and give it a few likes. So that's it for this week. Thanks very much for being with me. Look forward to being with you again next Friday. Thanks very much. Bye-bye now.